Welcome back. Emirates Airline has scaled back its 5 weekly flights to the Angolan capital Luanda to 3 due to the difficulty of repatriating revenue earned in the country. Hit by a collapse in the price of crude oil, Africa's second largest oil exporter has been depleting its reserves at a faster rate to fund imports and pay down government debt and imposed capital restrictions, including amounts travelers can take abroad. Emirates says the limitation on flights, which came into effect on Sunday, would also come under review very quickly if significant progress on the moving its funds out of the country was not made in the coming days. The Gulf airline also terminated a deal with Angolan airline TAG, under which Emirates took operational control of the airline for 10 years, and the two cooperated on commercial opportunities on the continent. The agreement was signed in 2014. And to commodities issues now, Tanzanian President John Magufuli has signed into law new mining bills which require the government to own at least a 16% stake in mining projects. The laws, which also increase royalties, tax on gold and other minerals, were passed by Parliament last week despite opposition from the mining industry body. Mr. Magufuli says no new mining licenses will be issued until Tanzania puts things in order, and that the government will review all existing mining licenses with foreign investors. The president has sent shockwaves through the mining community with a series of actions since his election in 2015, which he says are aimed at distributing revenue to the Tanzanian people. And oil prices edged up today, lifted in part by a strong demand outlook for the coming weeks. But overall market conditions remain weak on the back of ample supply and a more subdued outlook for long-term demand. Brent crude futures were at $47.07 per barrel, up 19 cents from their last close. U.S. West Texas Intermediate crude futures were at $44.56 per barrel, up 16 cents. Traders say the uptick in prices were in part due to healthy demand expected in the coming weeks. In the meantime, the Organization of Petroleum Exporting Countries and Non-OPEC Producers have invited Nigeria and Libya to their committee meeting in Russia. The meeting, set to hold on July 24, is aimed at discussing the stability of their production. Our crude sank into a bearish territory last month amid concerns that the cutbacks by OPEC producers, Russia and other allies are being partially offset by a rebound in supply by Libya, Nigeria and the U.S. shale output. Let's have more discussions on this with research analyst at financial derivatives company, Desola Sumoni. Good afternoon, Desola. Thank you very much for joining us.
Good afternoon, Kimi.
Now, Nigeria and Libya are to attend the meeting in Russia. Do you think these two countries will be asked to cut production?
No, I don't think asked to cut time. However, what I think more likely is that they'll be asked to cap their production at desirable levels, maybe when they have reached a certain level of production that is satisfactory and where they can get revenue from. Maybe for Nigeria about 2 million barrels in a day, and for Libya about 1 million barrels a day. If they can get to such levels, then OPEC can ask them to freeze production at such levels.
Now, will a supply cap on Nigeria at just around 2 million barrels per day and Libya at around 1 million barrels per day achieve the desired effect on oil price stability?
In my view, I think that if Nigeria and Libya are asked to cap their production at 2 million and 1 million barrels per day, I think it would cause prices to inch higher a little bit, but not stabilize the market, because the market is still evidently oversupply. I mean, data from the EIA shows that American US crude stockpiles is still about 100 million barrels more higher than the 5-year average. So we still have an oversupply in the market. While it is true that both since OPEC extended their production deal in May, that crude from Nigeria and Libya increased by a total of 440,000 barrels, and the cuts from Saudi Arabia increased. The cuts from Saudi Arabia was 460. So it somewhat offsets it, but I do not think that it will cause the asking Libya and Nigeria to freeze production now at current levels would cause price to increase significantly. I don't think so.
Now, with the trend, with what is happening in the global oil markets, do you see OPEC at this meeting, July 24, deepen production cuts, perhaps extend the cut deal?
No, I do not think that OPEC would deepen their production cuts at this time. I mean, they just made the decision to extend the cuts in May, so I think it is too early and to be a premature decision if they deepen now. I don't think they would. However, some analysts, Goldman Sachs in particular, have said that for the oil markets to stabilize or for the excess crude to be drained out of the market, that OPEC might need to cut further. But Russia and its allies have kicked against cutting further, and I do not think it will be on the agenda for this meeting.
Now, in the event that Nigeria, is asked to cut production, we don't know about that. Do you see this country that is actually trying to get out of recession, what do you think the implication would be for the country?
Okay, well, conventional wisdom states that our budget benchmark is about 2.2 million barrels a day. Now, our price benchmark is 44.5 million barrels, $44.5 per barrel. Now, if we are asked to freeze our production at 2 million barrels in a day, would be missing out, or there will be a revenue shortfall or an opportunity cost of 200,000 barrels a day. So somewhat that would affect our revenue targets. It would also increase our budget deficit, and it could possibly constrain the effects of the central bank to defend the naira and stabilize the FX market.
All right, thank you very much, Desola. I have to let you go at this point. Thank you for your time. Desola Sumoni, research analyst with Financial Derivatives Company here in Lagos. And finally, gold edged lower today on a firmer dollar and equities as the market awaits clues on the path of interest rate hikes in the United States ahead of Federal Reserve Chair Janet Yellen's testimony on Wednesday. The market was looking ahead to Wednesday and Thursday as Yellen would deliver 2 days of testimony on the U.S. Central Bank's semi-annual report on monetary policy and the economy. Spot gold fell 0.2% to $1,211.41 per ounce. U.S. Gold futures for August delivery fell 0.2% to $1,211 per ounce. And that's a wrap on the program. Thank you very much for watching. I'm Chimeze Obi. You're welcome.